Hey everybody, my name is Sam Kwak, a certified financial education instructor, and in this video, I'll show you how you could pay off your mortgage in as early as 5 to 7 years. In fact, here's a homeowner, an example, who is using the very concept that I want to share with you today. This is Shane, who's been a loan officer for almost 12 years. Yet, when he discovered our strategy, he says, "This strategy is brilliant and I will pay off my home in 3.2 years, saving over $125,000 of interest." But here's what's surprising. This concept and strategy is not about making biweekly payments, changing your income, cutting back on spending, or just eating rice and beans. The concept actually has to do with where you're storing your paycheck and savings. In fact, the concept that I want to share with you today is actually being used by homeowners in Australia to pay down their mortgage faster and save money on interest. Now, chances are you're in your 40s, 50s, or even 60s, realizing that you have a long way to go on your mortgage. And the scarier part is feeling behind on your financial prep and retirement plan. It's likely that your mortgage payment takes most of your cash every single month. Plus, you feel like your retirement savings are far from enough. So you know time is ticking and you feel like you're behind. And that's probably why you clicked on this video and you're looking for solutions. So what I'm about to share with you in this video could definitely help you pay off your mortgage in as early as 5 to 7 years. That way, you can focus on boosting your retirement and investments, which of course translates to gaining more control of your financial peace of mind and independence. Now, before we officially get started, I do want to clarify that although I'm a certified financial education instructor, I am not an attorney, I'm not a tax professional, or a licensed financial advisor. My job today is to simply educate you on a concept and strategies that are different and unheard of. So please talk to professionals before taking any action or implementing anything that I share with you today. Oh, and be sure to stick around to the very end of this video because I do have a special gift for you, absolutely free. So first of all, you might be asking, why should you pay off your mortgage in the first place? Why not invest any extra cash or funds that you have into the market, such as the S&P 500, in a form of a mutual fund, an index fund, or an ETF? Well, let me share a quick little story to illustrate the true cost of your mortgage, and it's actually quite surprising. Now, while this story is fiction, it does capture the essence of the true cost and the problem when it comes to your mortgage. Meet Sarah, a dedicated teacher who has been shaping young minds for over 20 years. So picture her in her cozy home, surrounded by photos of her grandkids, and her big dream is to retire at 65 and finally take that trip to Italy that she's been promising her husband for years. And so she's in her mid-50s, so she's definitely thinking about planning for her retirement. Sarah and her husband, John, bought a brand new home about 5 years ago. But one day, while randomly rummaging through her mortgage documents, she spots this. See this document? This document is part of her mortgage and it shows how much interest she would pay. It turns out that she's going to pay close to 139% interest on her 7.231% interest rate loan. Now, this is called a TIP, or total interest percentage, which is different than your interest rate. But that's not all. During the 5 years she's been making the mortgage payments, she's only paid down roughly $8,000 on her actual mortgage principal balance, the actual loan amount. And that's not the worst part. Sarah and John have been talking about moving across town to get closer to her kids and at the same time, downsize into a smaller home. I mean, after all, they're empty nesters. She realizes that if she decides to sell the house and move, she would have to get a brand new mortgage, which means most of her payments will yet again go towards the interest. And so here's a visual illustration as to why that is. Okay, so what you're looking at is something called the amortization graph. All this shows you is how your mortgage is paid down and how each of your payment is being divvied up between interest and principal. And if you are unfamiliar with this graph, the line that goes from left to right represents the amount of the time you spend paying down your mortgage. The line that goes up and down is the actual payment amount, your monthly mortgage payment. So in the case of Sarah, she's paying roughly about $525 a month towards her mortgage. And as you can see, there are two distinct highlighted areas, blue and red. The blue highlighted area represents the amount of interest she pays in a given month, whereas the red highlighted area represents the principal amount she pays for each mortgage payment she sends every single month. So in the first 5 to 10 years, depending on your interest rate, most of the payment is going towards interest. And it isn't until the second half of your 30-year mortgage where most of your payments are actually now going towards principal payment to further and aggressively reduce the loan balance. Now, of course, this isn't a problem if you have 30 years to wait, but most of us don't. And the problem is that I'm going to draw a line in the 7th year mark. And the reason why I'm drawing a line on the 7th year mark is for this reason. According to the US Census Bureau data, the ACS 2007 data, the average adult in the United States can expect to move about 11.7 times in their lifetime. Meaning if Sarah and John lives to be about 80 years old, they will be moving every 6 to 7 years. Now, in this scenario, John and Sarah are wanting to move because they want to get closer to their kids, but they also want to downsize. But for other people, there might be different reasons, such as a new job in a different state, maybe your neighborhood, the city, or the state isn't what it used to be. So there are various reasons as to why you might move. And even if you are in your 50s, 40s, or even your 60s, there's still a chance where you could move 1 or 2 more times in your lifetime. And so what that does to your mortgage and the cost of interest is that if you've lived in your current home for, let's say, 7 years, and you've been making mostly interest payments all along, and you have to move on that 7th year mark, well, guess what happens? You don't get to continue making the progress you've made, right, beyond that 7th year mark. If you get a brand new 30-year mortgage, you have to start all over, back to square one, where vast majority of your monthly payment is yet again going towards interest. And this is why, if you know someone in your life who's owned homes for the last 30, 40 years, but yet they still have 25, 27, 28 years left to go on their mortgage, well, this might be why. And this is why I believe that, sadly, most American homeowners are stuck in this perpetual cycle where they make it to the 7th year mark, they have to move, get a brand new 30 years, start making payments again where most of the payments is going towards interest, make it to the 7th year mark, and unfortunately find themselves having to move again and over and over and over again until by the time you're in your 50s or 60s, you're still working on your 30-year mortgage. And so as a homeowner, if you're in this perpetual cycle of just doing the first 5 years of mortgage payments, guess what? Most of your mortgage payment is just going towards interest, and therefore the interest cost can dramatically multiply even if you have a 3, 4, 5% interest rate. And if you have a higher interest rate, say, or 7 or an 8, you're going to be in a much worse situation. And not to mention, if you get a brand new 30-year mortgage, you're basically resetting the clock. And so for Sarah, if she does want to follow through with her decision to move to get closer to her kids, that means she's going to have to bump into another 30 years. And the first 5 to 10 years of her mortgage payment is yet again going towards interest. At this point, she doesn't want to wait another 30 years to pay down her mortgage. Sarah's now scared that her mortgage could outlast her career, or worse, her health. She'd basically be back in the cycle of paying mostly interest when it comes to her mortgage payment. And so she feels stuck and cornered about her situation. Now, the whole point of the story is that even though you may have a 3, 4, or 5% interest rate mortgage, it's not a guarantee that you would keep it forever. And a lower rate doesn't necessarily translate to paying off your mortgage faster. So just because you might have a low interest rate, you're not in a better place if you're stuck in a loop of paying mostly interest over and over again. And this cost just might outweigh the benefit of investing, at least for now. So then what is this concept that could help you pay off your mortgage in 5 to 7 years? So let's go and continue with Sarah's story. So later on, Sarah discovers a concept known as the Accelerated Payoff Strategy. It's kind of like finding a hidden shortcut for paying off her mortgage faster. First, Sarah is introduced to a new loan called a home equity line of credit, or a HELOC for short. Now, at first, Sarah didn't know what a line of credit was, but her curiosity pushed her to learn more. Sarah learns that a HELOC is like a credit card that is attached to her home equity. She's able to borrow from her HELOC and pay it back. And she's able to borrow from again and pay it back over and over, just like a credit card. But with the mortgage, as you might know, you can only make payments to it like a one-way street. On the contrary, a HELOC is a two-way street, enabling you to borrow from it, paying it back, and borrow again. Now, she then learns that she is able to withdraw from her HELOC to pay a large payment on her mortgage. This dramatically lowers her mortgage balance and thus the mortgage interest accrual. But because she borrowed money from the HELOC to pay down her mortgage, she now has a balance on her HELOC that she owes. Now, at first she was confused because this felt like using a debt to pay off debt, or in other words, borrowing from Paul to pay Peter. So she thought, I don't see how using a HELOC is helping me pay off my mortgage faster, let alone the HELOC typically has a higher interest rate. How does this all work? Well, the next part is where it gets interesting. Sarah finds out that a HELOC can be paid off in a different way than a mortgage. This difference can save time and interest. And in fact, the difference is that the mortgage uses monthly interest calculation, whereas the HELOC uses daily interest calculation. While both are a form of interest calculation, it's kind of like comparing Celsius versus Fahrenheit when measuring temperature. So Sarah remembered that she can borrow from her HELOC and pay it back and then borrow again at any time. She also learned that her paycheck is sitting in a checking account that isn't hardly paying any interest at all. So instead, she could deposit her entire paycheck into the HELOC. Now, of course, she wondered, this is crazy. Why should I take my entire paycheck and pay down my HELOC? She was extremely nervous about that idea, as you can imagine. However, she learns that every dollar she deposits to the HELOC reduces the balance that the bank uses to calculate her daily interest. Now remember, a mortgage interest is calculated on a monthly basis. On the contrary, a HELOC calculates interest daily. This, in turn, could save her money on the interest. But with a mortgage, she can't do that. Because if she were to send her entire paycheck to the mortgage, well, she can't get any of it back for her expenses like groceries, gas, food, you name it. But with a HELOC, she absolutely can. And that's where it clicked for Sarah. The bank determines the mortgage interest from the balance at the end of the month. But for a HELOC, the HELOC calculates the interest based on what the balance is for each day. So let's say Sarah's HELOC balance today is $5,000, and then it goes down to $2,500 the next day. The bank would calculate a different interest amount for those 2 days. So realizing this, Sarah begins to use her HELOC like a checking account. She pays for her groceries, bills, her weekly book club out from her HELOC. And when she isn't using any part of her paycheck, it sits in her HELOC, saving her interest every single day. It gives her, one, the flexibility to access her hard-earned money, and two, it's saving money at the same time when it comes to her interest. So fast forward 5 years later, Sarah's mortgage is gone. Not in 30 years, but in fraction of the time. She's 57 now, and her home is free and clear. Her home is finally hers, and the money that used to go to her mortgage now builds a retirement fund. Now, her dream of a trip to Italy with her husband is becoming more and more real, and she's not stressing about bills whatsoever. The accelerated payoff concept showed her a clear way to gain financial independence, control, and clarity. The money that would have gone to her mortgage payment is now used to grow her investments. So, having heard of Sarah's story, some of you are getting the picture. Why not have your paycheck do more than just sitting around in your checking account doing nothing? This way, you can lower your debt and still access your cash when you need it. But now, I get some of you aren't still fully understanding the concept. I mean, you get the part about using a HELOC and how it's different from a mortgage, but how is that all still helping you pay off your mortgage faster, you wonder? And how is this exactly different than paying extra into the mortgage or doing bi-weekly payments? So allow me to use a visual aid to show you what Sarah's typical month may have looked like so that you can see the mechanics of how it's saving you money. And again, just as a reminder, this is an educational example and an illustration to help you grasp the accelerated payoff concept. So it's not a guarantee of a promise or an outcome or anything like that. Let's say Sarah started her month with a $10,000 balance on a loan that charges its interest on a monthly basis. So let's say in the middle of the month, she makes a $1,000 principal payment. And by the end of the month, she'd have a $9,000 loan balance. Get it? And let's say, for the sake of this example, the interest rate on the loan is 6%. That means Sarah would need to pay $45 of interest at the beginning of the next month. And so remember, with a monthly interest calculation, the interest is calculated on the ending balance for a given month, 9,000 times 6% interest divided by 12. That's the interest amount. But let's look at what happens if this loan were to be a HELOC at the same interest rate of 6%. So instead of making a one-time of $1,000 payment, she'll instead deposit her entire income into the home equity line of credit. So let's say Sarah gets paid $5,000 a month. And like most people, her paycheck is paid biweekly. Her first paycheck of $2,500 is then deposited directly into the HELOC. Now, what this does is it immediately lowers the HELOC balance down to $7,500 on the first day of the month. But remember, the interest is calculated daily on a HELOC. Therefore, she can expect to pay $1.32 of interest each day as long as the balance remains at $7,500. And when her second paycheck comes in, she deposits that into the HELOC again. Now, her HELOC balance is $5,000. And moving forward, her daily interest is now just 82 cents as long as the balance stays at $5,000. But wait, how is Sarah going to pay for her groceries, gas, food, and everything else? Well, remember, a HELOC is a two-way street loan, meaning that you can take the money back out when you need to at any time. But here's what she does that's so darn smart. She uses a credit card for daily expenses instead of withdrawing money from her HELOC. Why? Well, unlike a HELOC, a credit card doesn't charge you interest right away until the next billing cycle. When she uses her credit card to pay for groceries, it's not affecting the HELOC balance at all. She's in the credit card grace period where interest isn't being charged. So really, the only time where she has to pull the money out of the HELOC is to pay for her statement balance on the credit card or any other bills that she can't pay using a credit card. Oh, and of course, she's collecting those credit card points for free travel as well. So then what does that look like for our HELOC? Well, let's say she pulls out $4,000 on the 28th day of the month to pay for her credit card statement balance, as well as the cash she needs to pay for bills that cannot be paid using a credit card. Now, what that does is that it brings the HELOC balance back up to $9,000. Now, you might be saying, wait a minute. The HELOC ending balance is exactly the same as the previous example with the mortgage that uses monthly balance. Sam, what is this? Is this some kind of scam? Well, no. Remember, HELOC interest is calculated daily but paid monthly. The bank then adds up all the daily interest that is charged for the month. By adding up all the daily interest, Sarah has to pay a total interest cost of $32.29. Now, in the previous example, the interest cost was $45. That is nearly a 28% indifference for the interest cost when using a HELOC and its daily interest calculation to our advantage. So friends, this is why the accelerated payoff concept is not the same thing as paying extra directly into the mortgage. And the interest rate on the HELOC is not the end-all be-all or the entire story. Using this concept, Sarah basically cuts off nearly a third of the interest. That's third of all interest gone simply by changing where she stores her money. And of course, with the extra interest she saved, she can further add that towards her loan balance, which saves her interest even more, having a little bit of a compounding effect. So when we look at both examples of a monthly interest calculation and a daily interest calculation, Sarah ends up with the exact same ending balance at the end of the month and the same exact interest rate. However, the results were drastically different. And that right there is the difference between monthly interest and daily interest when used wisely to our advantage. So to explain the high-level overview mechanics of the strategy, here I have a fellow expert, Joe Franken, to help explain how it works.
Yeah, my name's Joe Franken. I'm a CPA, have an MBA, and I've had a 25-plus year career that includes time in public accounting and personal finances. So at a high level, let's look at how this strategy comes into play. Let's say we have a mortgage with a $300,000 balance. We establish a HELOC of, let's say, $50,000. Out of the $50,000, we immediately borrow $25,000 and make a principal payment to the mortgage. That would immediately decrease the mortgage balance, speeding up the payoff. But now we have a $25,000 balance on the HELOC. What we just did was transferred a small chunk of the mortgage balance from a monthly interest calculating to a daily interest calculating HELOC. And the HELOC, of course, allows us to deposit all of our income, lowering the daily balance as we pay it down. And any expenses like grocery, gas, food is paid out of the HELOC when we need it. But when the cash isn't needed, it's put towards the HELOC, lowering the daily balance, thus saving us the interest. When we then continue the strategy using the line of credit, we repeat the process, making another $25,000 principal payment to the mortgage. The magic of these big chunks is it pays down your mortgage and takes a significant amount of time off that mortgage payoff. This strategy works a lot better than doubling up on payments to your mortgage or switching to a biweekly payment. It's the big chunk payments that drive the result. Also note that we have a $50,000 limit on our line, but we only use $25,000 for the strategy. The excess availability, that's your safety net for life's curveballs that may get thrown your way.
So as you can imagine, Sarah now has extra peace of mind and control, knowing that she's able to save incredible amounts of money. But at the same time, she now has access to cash when facing unexpected life events because of the HELOC. This translates to now she has flexibility to see her grandkids across the country. She can travel to Italy. She's in a position where she doesn't have to work, but she gets to work if she chooses. Sarah no longer feels that there is a thick fog of uncertainty, fear, and confusion when it comes to her finances. Now, I know we've been primarily focused on Sarah's mortgage, but could this work for any other loans like credit cards, furniture loans, car loans, student loans? The answer is yes, it certainly could. Now, like I promised at the beginning of the video, I do have a special gift for you, and it's a free online accelerated payoff calculator. Now, what this calculator does, it allows you to follow Sarah's steps. All you have to do is just enter your mortgage information, your income, and expenses. In just a few seconds, the calculator will give you an estimate of how much money and time you could save using this very concept you learned in this video. This way, you can tangibly test the concept on your own for your unique situation. So, I hope Sarah's story shed light on how the accelerated payoff strategy works. But I know some of you still have questions and parts that weren't super clear. So after you download the free calculator, you'll have a chance for a free 30-minute consultation with our team. Our team of experts can answer your question and discuss how this concept fits with your situation. But I also know that there are some of you might be saying, well, Sam, I got this. I understand it now. I can do this on my own. I can go get my HELOC from a local bank and start trying this right away. Well, hold on a second. I know you want to try it on your own, but let me ask you this. Do you do your own taxes or even change your own oil? Well, probably not, because you might risk a tax audit if you do the taxes wrong, or if you try to do your own oil change, you might damage your car. And so there are all kinds of nuances and variables for every individual situation when it comes to applying the accelerated payoff concept. So before you go out there on your own, I really recommend getting with our team, because the unknowns are what could hurt you at the end of the day. So that being said, if you found this video to be helpful, be sure to like and subscribe and share this with your friend. And if you want to continue your journey learning, be sure to click on these videos on the screen to learn more. Download the free calculator, and we'll talk to you very soon. God bless.